Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. This week is going to be all about the Fed and the interest rates. That seems to be all of the headlines. Well, let's get to it. September meeting, our expectations, and let's face it, the market's been pretty clear, their expectations too. 75 basis point hike at the September meeting by the Fed, higher on the heels of multiple 75 basis point hikes during this summer. Number two, this is not a theme unique to the world. We'll take a look back at the end of 2020 compared to now, how dramatically different the global interest rate environment looks. And finally, labor market. That's the big part of the Fed's dual mandate, right? Inflation, everybody knows it's at its highest level since the 70s. Labor market is still pretty strong for now, and we'll talk a little bit about that. So I talked about the expectations for the September meeting. What we have here is a chart from the Chicago Mercantile Exchange, which has Fed fund rate futures contracts. Doesn't mean much to probably anybody, but basically what it is based on real dollars and transactions in the futures market around the Fed funds rate. They're able to basically say what the market's expectations and probabilities are based on those transactions. And right now, the market and that exchange is basically indicating an 80% probability that the Fed funds rate at the September 21st, 2022, remember that's post-Fed meeting, will be at a range of 3 to 3.25. Remember, right now, it's at that 2.25 to 2.5, indicating a 75 basis point hike in September. Why is that so widely expected? A couple reasons. Post-Jackson Hole, Jerome Powell came out with his most hawkish language ever, almost combating the equity markets from that June rally of 17%, where it almost seemed to be imagining a world where the Fed was going to reverse course really soon. Powell came out and basically refuted that. Several other Fed officials, even this week back in Jackson Hole and the past week, even as soon as today, have come out and basically said the labor market, remember we had a pretty strong jobs report in August, is warranting the Fed to combat inflation. They're going to be very vigilant in doing that. What's that mean? That means rates are headed higher, right? And that means they're going to continue to be aggressive. And I think the market is allowing them to do that, if you will, because we haven't seen the hit to the labor market right now. So 75 basis points in September, pretty priced into the market right now. As I said, take a look at global interest rates. This is a pretty fascinating chart. We can look back on December 11th, 2021, kind of the peak negative yielding debt. All these developed international and U.S. countries around the world at the various maturities across those columns from 3-month all the way out to 30-year. You can see how many different maturities and how many different countries. These are developed countries that had negative interest rates. Remember, that's right in the heart of the pandemic after it started, when all of these countries were trying to spur economic growth on the heels of that recession. Well, things have changed. We obviously had a ton of monetary policy, not only in the US, but overseas, record amounts of fiscal stimulus, personal savings shot up. We had demand-driven inflation. Obviously, we had some supply chain issues, but there's no doubt the amount of money that flooded into the economy to basically help this market rebound and the economy rebound at record pace, causing this huge inflation that we haven't seen since the 70s. Now, pretty much every bank, federal bank, central bank around the world is doing the same thing the US doing. Look at that right now. Japan's the only country in the room with negative rates still. Dramatically shifting market, worldwide inflation across the globe, not unique to the US, causing central banks to combat that with higher interest rates. Not always good, obviously, for bond markets and equity markets, which we can obviously see in 2022. And then finally, I talked about the dual mandate of the Fed, right? They want that steady employment, that full employment. Well, unemployment is still pretty low. We saw it jump up just a little bit to 3.7% in August after a pretty strong August report of 315,000 jobs in August. But we actually saw the labor participation rate increase. All that to say, the labor market's actually been pretty strong. And if you take a look at that chart on the left, the U.S. job openings, look how what a record that is at compared to history since 2000. We haven't seen anything like that number of job openings. There's a ton of jobs, not a lot of people searching. We're going to have to see that come down first before we see a dramatic hit to unemployment. And I think the Fed's movement eventually is going to start to cause some of this to happen, but it historically has had a pretty lagged effect. But this is what the Fed's going to be watching to see before they ever consider starting to pull back the reins. They're going to have to see a spike up in that unemployment rate before doing so. And finally, got a big weekend for those of you. I know college football's back, NFL's back, but for you moon watchers out there, you've got the famous or infamous harvest moon, notably coined that all the way back since 1700. Full moon right before the turn from summer to fall in the northern hemisphere here. And it peaks around Saturday, September 10th. For those of you who want to get up early tomorrow morning at 6 a.m., you're going to get that peak full moon. I guess they said it's going to last a few days here, but it's called the harvest moon because back when people actually did have widespread harvest, and there are still farmers out there, but agriculture was much bigger part of the country. You had farmers obviously staying up all night during this period because of the extra sunlight, if you will, or extra moonlight in this case, that was provided for working at night during this time. It was right before that August equinox turn from summer over to fall and then eventually to winter for those farmers. So get out there if you can. I might try. We'll have to see about the timing if I can get up early enough there to see that, but happens every year. So if you miss it, it'll be back next year. With that, I want to thank everyone for watching, and I'll see you next time.